I take your point that the longer term averages are pretty much par for the course, but rarely do you see markets go up significantly in a one-way trajectory without, even bull markets, without taking in a 10-12% kind of correction. That's par for the course even in strong markets. Do you think one of those could be lurking around the corner, which would come as a bit of a shake-up, because people have almost forgotten that there could also be corrections?
Actually, that we ourselves don't mind, because we run a hedge fund or a long short fund. But just to say, before this pandemic, if you were to look at the numbers from 2007 December, the market would have been flat even in rupee terms, more or less, I think. And in dollar terms, maybe down 4-5% per annum for 10-12 years. So it was in some sense very bad, because the corporate profits were bad and all these things. But there was some logic we were all believers in, which said that corporates have been benefiting at the expense of the overall economy, and their relative position is going up, because whether you looked at GST or you looked at DMON or you looked at RERA or you looked at corporate tax cuts, or later on if you looked at COVID, all of these hurt some of the weaker parts of the corporate sector or the unorganized, because they made it easier for the well-organized, the guys who were already meeting all these things, or who had funding and who didn't need black money and all that. And therefore that intra-India shift was happening. And now after COVID, maybe there is a new cycle. But the fact that whether there should be a 10% correction or not, or whether there can be a 10% correction or not, you would not even know. Nobody would know. India has had so many 8 to 10% corrections in a month that many times when I write my newsletter, which I write in the middle of the next month for last month, many times I have forgotten why the market had fallen 10% last month, because when I start searching that what exactly happened, there is no real obvious. So 10% type correction may be a shocker or not, but should be expected by everybody at any point of time. That's the way of overall equity markets, and Indian markets generally are much more volatile than say US markets, so you should expect that even more. But you can't keep waiting for it also, is what we would say today. It's part of the course.
Okay. Samir, interesting, because you've kind of talked a lot about how, while there is merit in compounding, it's important to be mindful and also keep taking a little off the table when we're seeing markets at these levels. Do you feel that the broader markets are slightly saturated right now, and your conviction lies in a few core segments? Is that how you're viewing things? For a retail investor, how should they approach the market?
So we say that there are three real long-term themes in India. One is financials, and actually financials haven't participated fully in the rally.
Yeah.
So if you see these private sector banks and you see their earnings growth in the last 5-7 years, like say HDFC Bank, Kotak Bank and all, their stock market prices would have gone up more or less in line with these earnings. They have not been, valued higher and higher for the same earnings. And even for the other insurance companies and a few NBFCs, broadly they have done in line with their earnings growth. If you look at this tech sector, the software services which we like, along with pharma and specialty chemicals, at least the tech part has been re-rated, but is genuinely doing well. And it seems that as intensity of technology investing share in an overall revenue of a company, because as everybody can imagine, companies will have to spend much more on technology going forward than they may have spent in the last 10 years. And this shift to cloud and everybody moving there, all that has shown that Indian companies are in the right place at the right time. So although those valuations are a little higher, right now we believe that we are participating in a massive, shift in terms of companies wanting to adapt to the new world. So the real, according to us, higher valuations and maybe unreasonable valuations have happened in the consumer sector, which otherwise is our third leg of our portfolio, where the same earnings growth of 10-12% type, which are more or less in line with GDP of India in nominal terms, their valuations, which used to be 30-40 times, are now 70-80 times in terms of PE. And so many of those we have left along the way of the last 2 years. We have sold many of them. Overall, at least financials don't look having massively re-rated, and tech has been re-rated, but it is much cheaper than the staple companies, consumer staple or consumer companies, with much higher growth and equally long tenure of growth in the past, and maybe at least there for the next 5-7 years or 3-5 years, which is long market participant.
Always great talking to you, Samir. Thank you very much for your time today, and good to
Thank
see
you.
you
Best
again.
of luck, both of you.